Is manufacturing signaling a market pivot? As expected, the manufacturing index fell more than expected, falling to a reading of 46.3. Last month's reading was 47.7, and anything under 50 shows a contraction. This is the fifth consecutive month of a sub-50 reading. As you can see from the chart below, we're still quite a bit higher than the bear market in 2001, 2008, and the COVID crash of 2020. But I don't expect we will get to those low levels this time, since this is not the same type of bear market. Just at the time that everyone says the recession will crush our spirits is around the time I expect to see the manufacturing index rise. Remember, news travels slowly. In the previous recessions, the manufacturing index was ticking higher while everyone was still talking about the market falling apart. We've already seen the market rebound some in 2023 as the index heads lower, but I think we will see the index tick higher in the third or fourth quarter of this year. As a result of the poor manufacturing report, bond yields fell. That helped the broader market move higher, with the Dow 30 posting a near 1% gain yesterday. However, it was OPEC's surprise move to cut production that gave energy the push higher, with crude oil up more than 6%. I'm expecting more chopping sessions this week since it's a shortened week, but volatility should be back again as we kick off earnings next week. That's just in time as the volatility index, VIX, is nearing a 52-week low. That's potentially good news for option sellers though. The scanners I use aren't flashing too many signals, so let's go to everyone's favorite, Tesla, TSLA. For the trade idea on Tesla and more on this story, visit tradersreserve.com.